gave up managing billions to become a better investor. Episode 36. Relax ahead of the late September excitements. Hello. Yes, it's late-ish September. It's been actually quite a sort of a chilled, quiet time, thankfully, in financial markets. Yes, I know there's been a bit of volatility. There's certainly been plenty of excitement from broker types and related coming back from their summer holidays, commenting on everything. But for me, actually, it's been quite a quiet time, a sort of time to be thoughtful, really. Mainly because, of course, the corporate earnings season is 99% finished. Yes, there's a bunch of smaller caps and related coming out with numbers and a few large caps as well. But most of that's over. And it's kind of interesting and fascinating to me, just actually less than a month to go before the next corporate earnings season. So there's kind of lots of musing about that. A few companies are having kind of capital markets days, giving updates where they sort of don't say anything about their sort of next set of numbers, but they're sort of giving some insights into what they're doing in terms of the direction of their business. Geopolitics remains kind of interesting as always. But I guess really the main excitement in the upcoming week undoubtedly is the fact that we've got a bunch of big central banks coming up with their latest thoughts on the subject of interest rates. Federal Reserve, Bank of England, Bank of Japan, thoughts from other countries in the world too. So lots of interest rate excitement. Of course, last week we had the ECB erroneously, I think, raising interest rates again. That was an interesting conference call, actually, or in the sense that there was discussion about, well, why is the ECB raising rates when there's been, interestingly, a kind of a recession or slight recession in Germany? Inflationary thoughts have been continuing to go down. German bond yields have certainly been coming back as well, going down, lower yields, higher price, etc. So it seems to me as if some of the still retained fears about the inflationary backdrop in Europe is a little bit overdone. Again, thoughts about, well, aren't we seeing things such as wages kind of being firmer than we thought, kind of not kind of responding to some of these anti-inflationary issues out there, slowing growth issues? Are there some technical factors which we've got to be worried about too? But I mean, as I've discussed many times this podcast, and no doubt will continue to do so over the next few months, let's face it, higher interest rates, it takes sort of thick end of 18 months to work through. My guess is, yes, the ECB were late in starting to raise rates, certainly the latest, the last of the major central banks to start this process, probably correctly on that basis. But again, as with many of the central banks, they should have probably raised interest rates a bit quicker. But there you go. Maybe Europe and the ECB does have some bigger issues out there. But if they have big issues, then surely they'd be copying the Bank of Japan, which is still not raising interest rates. So there you go. Interesting backdrop. Looking forward to thoughts from the Federal Reserve and the Bank of England, as I said, in the next few days. Sadly, I think the Bank of Japan will continue to avoid really effectively changing policy at all. But if I was the Fed or the Bank of England, I would still not raise interest rates further. But it seems I was reading an interesting piece earlier today that 90-something% of thinkers believe that the Bank of England will raise interest rates. But, again, that consensus view feels kind of a bit wrong. And as I've talked about before, it's always right at the start of the cycle, at the end of the interest rate cycle, where central banks sort of get it wrong or kind of miss on a hindsight basis, miss the correct decision thought. And I kind of feel we're there at the moment, but we shall see. What I do know is that bond yields, if we look in the States, for example, 10-year US government bonds, it's kind of interesting. They've sort of got a bit stuck. And even though I kind of perceive that bonds, be it corporate bond investments or central bank bond investments, will actually make investors a little bit of money over the last sort of 3 and a bit months of the year, kind of interesting to see that there hasn't been a particularly big movement, perhaps a bit less than people would have thought. And actually, year to date, many bond investors have struggled to make money, particularly outside of the corporate bond arena. And of course, that reflects the reality that underlying inflation, I know there's still great desire by the global central banks to move to 2% interest rate, 2% base underlying inflationary numbers. But reality is that I just think we've got to get used to the underlying reality of personal inflation rates of, let's call it 3%, or something which I've called before in the kind of 2 to 4% range. We shall see on all that front. My observation would be that if I was a central banker, I would not be raising interest rates at the moment. I think there are kind of bigger issues out there to be thinking about, certainly from a medium term, aka the next 1 to 2 year perspective. Tell you what else has been interesting, of course, in the last week or so, and that is the IPO of ARM. Now, I've touched on this before, that ARM, obviously a tremendously successful initially UK intellectually UK-centred technology company, ultimately, of course, purchased by SoftBank, albeit though that it performed extremely well at times in the FTSE 100 index, but bought by SoftBank, what was it, 7 odd years ago, and now 10% of the company sold. Everyone was thinking, well, what was the price going to be listed at? $51 was the eventual US technology launch level. Of course, they chose the States because of the higher valuations being undertaken there, and I guess maybe higher awareness of technology investments but let's face it, global investors can buy shares in any market, and disappointed really that the London Stock Exchange failed to get hold of the initial ARM re-IPO. But anyway, what's kind of interesting is that that $51 level, when you looked at 1 minute after the formal IPO, the share price was at $60, and kind of interesting. So the bunch of institutional or other technology investors who got hold of some of that, quite small, let's say only IPOing 10% of the company, 90% still being owned by elements of SoftBank, is always going to be a sort of a pretty tight IPO, even though, of course, ARM is a fairly large company in the wider scheme of things. What is it? Biggest IPO in the States for a while. Hence the excitement there, I guess, to some extent too. The allocation given to a bunch of other technology names and the like, and no doubt a few special institutional investors too. So they've all done rather well, getting the stock of $51, hitting 60 from the get-go. And so kind of interesting, and again, fits in really with my view that the ARM IPO was one that I was not going to look to chase, not going to justify having any investment in, mainly because I was worried or concerned about that element. Kind of interesting to see on day one and a bit of the IPO last week, you had the ARM share price moving from that initial $60 level. Of course, the press getting very excited about, oh my goodness, it's been a super successful IPO. Obviously underestimating the fact that any individual investor wanting to purchase would have to have bought the stock at $60 plus in order to get exposure on day one, moving up to sort of $67, kicking around at $65. And now when I look at a few minutes ago, the stock's at sort of $56. So again, it's an indication that if you were somebody who bought that stock on day one, you had let's call it a thick end of a day opportunity to buy the IPO at $60 odd, sell it at $60 plus level. But now, if you've been holding it for what would now be, I guess, day three of the IPO period, you would have lost money, which is again an indication that you've got to be careful. As I've said, with not just technology stocks per se, you've always got to be careful on technology stocks. Frankly, you've got to be careful on all stocks. It's an active investment market. We know that. But particularly when the tech space, when you've had a fantastic year-to-date performance after a lousy 2022, technology is volatile. Yes, it is the future, but let's face it, that also means volatility, and careful selection is oh so important. Valuation is not right there. Therefore, the need for a proper pucker active management, frankly true in all sectors, let's face it, but particularly true in areas which are highly valued, highly perceived. You've got to be careful. So am I surprised that as I speak, if you bought those ARM IPO shares on day one of the re-IPO, you've struggled. Actually, if you've held it for more than 2 and a bit days, you probably haven't made money, which brings us back, of course, to the need for, I think, a little bit of profit taking in perhaps very successful technology investments that people have made. As you know, as I disclosed over recent weeks, I have, for the first time in a long time, taken some profits on my Alphabet investment. Yes, I have bought some other different technology companies which have been a bit more out of favour, the Alibabas of the world and related. But for me, when I look at the sort of the excitement around the Nvidias, which people have done fantastically well if they've been smart enough to buy it, let's say a year ago or 9 months ago, even at the start of the year, when it's suddenly super excited, it's hitting the headlines on the TV, in the press, etc., you've got to be cautious. You've got to be careful. Is everything kind of factored in for the moment? Should I be waiting for the next set of numbers to come out on the quarterly earnings cycle and related? On the question of ARM, absolutely. I'm looking forward to the next set of quarterly numbers because I think it's going to be kind of interesting. That's when you can really get some insight as to whether there is some real value there or not. My personal instinct is I'm just going to chill on this stock. I'm not going to invest in it. I'm going to wait for the upcoming quarterly numbers at the next quarterly earnings season and see where we go on that front. Ditto the Nvidias and a bunch of other technology names out there. As for Alphabet, I've top sliced notably my position, been a super successful investment over many, many years. And if it hits $150, then I will sell some more. Great company, Alphabet, on a strategic basis, but everything has a fair price. Certainly has a level where if it's one of your biggest positions, you've got to be saying, is that now justifiable? Even though I love the medium-term story, would it be a bit more prudent for it to not be number 1 or 2 in my portfolio? Should it be number 10 or 15 or something? And that's what I've done with Alphabet. As always, in an active world, you've got to be thoughtful, and it's no bad thing to take a little bit of profit now and again. No bad thing at all, even if a company is still going to be hopefully successful over upcoming years. So kind of an interesting backdrop. Going to be a busy week with central bank thoughts, not too much out on the individual corporate front, a few names out as always, but nothing that's really striking me as super exciting or being particularly wanted to be all over like a rash. My general thought would be keep thinking, keep being careful, but ultimately looking forward to what the quarter 4 period of 2023 is going to bring us, and ultimately initially at least another set of quarterly results numbers, which then will help people think, well, what is 2024 going to bring us? Because we're moving closer and closer towards that nearer Christmas, end of the year. How's 2023 been? Where's 2024 going? You know my general thoughts. I still think there's more money to be made through careful selection in both bond and equity markets. I would still say, though, you know my thoughts on bond allocations. If you're certainly an investor below retirement age, that the main excitement still remains in equity markets with an allocation to alternatives. You know my thoughts on gold being a particular area of interest for me there. But that's where diversification ideally comes from, not from, oh my goodness, I've got to be in a 60-40, 50-50 portfolio because that's the smart thing I'm being told. I'm still not convinced that's the case for the rest of the 2020s. But hey, if you are a bond investor or even a cash investor, you will make a bit more money as this year progresses. I still would say, though, a careful, cautious, carefully thoughtful equity investor will actually do the best. That's still my instinct. Anyway, more thoughts later in the week when perhaps we've had some insights from a number of, for a few more of the world's important central banks, particularly the Fed and the Bank of England, and we'll go from there. So thanks for listening. Speak to you soon. Bye-bye.